Imagine waking up one day, and your neighbor's house that sold for $500,000 6 months ago is now listed for $400,000. Interest rates have jumped. Banks are nervous. Builders are slowing down. Everywhere you look, people are asking, is the housing market about to crash? Hi, I'm a property marketing expert with over 10 years of experience. If you're new to real estate, you might be hearing terms like bubble, crash, market correction, or housing. Is this just hype, or is something genuine brewing? In this video, I'll walk you through what's really going on in 2025, what the headlines say, what most people are not talking about, what's likely to happen next, and most importantly, what you need to know if you're thinking of buying, selling, or investing. If you stay with me for the next few minutes, you'll be able to recognize the signals that are often ignored. 2. Understand whether your region is more likely to crash, or simply cool. 3. Take action that protects you financially, not panics you. Let's start with where things stand right now. Section 1, what's happening in 2025, 0:45 to 2:30. Alright. To understand whether a crash is coming, or whether things are more stable, we have to look at the key changes that have already taken place. 1. Rising interest rates. Over the past year or two, central banks in many countries have been raising interest rates to combat inflation. What that means for you: mortgages are more expensive. If 5 years ago you could lock a home loan at, say, 3 to 4%, now similar loans might be 6 to 8%, or more, depending on where you live. That increase can significantly raise monthly payments. Many buyers are being priced out. Sellers see fewer people able to purchase. It cools demand. 2. Inventory buildup and slower sales. In several markets, especially ones that boomed during low interest periods, there's now more housing available than there were buyers willing to pay top dollar. Homes are staying on the market longer. Sellers are dropping prices or offering incentives. Some new constructions are delayed because of higher costs or supply chain issues. 3. Shifts in work and lifestyle demand. Remote work, hybrid models, and shifts in what people want have caused changes in which areas are desirable. Urban core markets are seeing less demand compared to suburbs or smaller cities. People want more space, better amenities, shorter commutes, and often more affordability. So city center housing demand has weakened in many places. Suburban or outlying areas might still hold up better. 4. Regional differences. This is critical. The housing situation is not uniform. What's happening in, say, a fast-growing tech city is very different from what's happening in rural or stable small towns. Some markets are overheating, others barely moving. A crash in one place might be a small correction or cooling in another. That's the current landscape: high rates, more supply than strong demand in many hot markets, changing buyer preferences, and big differences depending on your region. What is the price drop you might already be seeing? Because local conditions matter more than national averages. When you hear the word crash, it's easy to picture 2008 all over again: banks collapsing, prices in free fall, and people walking away from mortgages. But here's what most news articles leave out: the fundamentals of housing today are very different. 1. We're still undersupplied in many areas despite headlines about more homes on the market. A lot of regions actually have fewer properties than they need. Builders slowed construction for years after the last big crash, and zoning rules make new projects slow to approve. Even with inventory creeping up, many cities are far from oversupplied. 2. Demographics are on the market's side. Millennials and Gen Z are entering prime home buying years. This group is bigger than the generation that came before them, and most still want to own. That creates a steady base of demand, even if interest rates make them cautious. 3. Lending standards are much tighter than pre-2008. One of the reasons the 2008 crash hit so hard was risky lending: zero-down loans, no income verification, and speculative flips. Today, banks are far more conservative. Buyers usually need good credit and a solid deposit. That means fewer people are overleveraged, and fewer forced sales when prices soften. Put simply, while some areas may correct, the system as a whole is sturdier than it was 15 years ago. That doesn't mean prices can't dip. It means we're less likely to see a total collapse. To understand 2025, it helps to compare with earlier slowdowns. Early 1990s, mortgage rates jumped, home values cooled, but markets rebounded once rates eased. 2008 global financial crisis, prices plunged because risky loans and speculation collapsed. 2020 to 2022 boom, Ultra-low rates and pandemic lifestyle shifts sent prices skyrocketing, creating today's affordability squeeze. The lesson? Real estate doesn't move in a straight line. It cycles. Corrections are normal after big surges, and the depth of a slowdown depends on lending rules, supply, and economic health, not just fear. As a beginner, that's encouraging news. A dip can feel scary, but for long-term owners or investors, it often means opportunity rather than disaster. Now that we understand what's happening and why, let's talk about what you can actually do. If you're thinking about buying your first home, start by getting pre-approved so you know exactly how much you can afford at today's rates. Focus on a long-term horizon, at least 5 to 7 years. That way, even if prices dip right after you buy, you have time for the market to recover. Choose location and quality over speculation. A solid house in a stable area will hold value better than a flashy property in a risky market. If you already own a home, don't panic sell just because headlines mention a crash. Check your equity, your mortgage rate, and your local supply levels first. If you're on a variable rate and payments are rising, talk to your lender early about refinancing or adjusting terms. Keep your property well maintained. Well-presented homes still sell quickly even in cooler markets. If you're investing, be patient and run the numbers carefully. Cash flow matters more than chasing appreciation right now. Consider diversifying. Maybe a REIT, real estate investment trust, or a small rental instead of stretching for a big flip. Always keep an emergency fund so you're not forced to sell at a bad time. These steps might sound simple, but they separate people who thrive in a slowdown from those who get caught off guard. So, what's my take after more than a decade in property marketing? We're likely to see a correction rather than a crash in most places. Overheated cities, ones where prices soared 30 to 40% in just a few years, may slide 5 to 15% as higher borrowing costs spike. But regions with housing shortages, strong job growth, or steady migration probably won't tumble. They may just flatten or give up a little of their pandemic-era gains. The key point: housing is hyperlocal. Broad headlines can't tell you what's happening in your postcode, so always check local data and talk to a trusted advisor before making big moves. A cooling housing market doesn't have to be bad news. For some, it's a chance to finally buy without frantic bidding wars. For others, it's a moment to pause, plan, and make sure their finances are solid. If you found this breakdown helpful, hit that like button and subscribe. I share weekly insights to help beginners navigate real estate with confidence. And in the comments, tell me, what's happening in your local market? Are you seeing price drops, or is demand still strong? Remember, the best decisions in property are made with clear information, not fear. Thanks for watching, and I'll see you in the next video.